Hey everyone, and welcome back to the channel. Today we are diving deep into a topic that could save UK landlord couples a significant amount of money. How you split your rental income for tax purposes. If you're married or in a civil partnership and own a rental property together, this one's for you. We'll cover everything from the standard 50/50th split to the game-changing Form 17 and how to legally structure things to your advantage. So grab a notepad because this could genuinely change how you manage your property finances. First up, let's talk about the default position. When a married couple jointly owns a property, HMRC automatically assumes that you share the rental income and therefore the tax liability equally. That's a 50/50th split, regardless of who actually paid for the property or how much each of you owns. For many couples, this is perfectly fine. If you're both in similar tax brackets, it's simple and requires no extra paperwork. The rental profits are divided down the middle. You each declare your half on your self-assessment tax return, and that's that. Easy. But what if you're not in similar tax brackets? What if one of you is a high-rate taxpayer, paying 40 or 45% tax, and the other is a basic rate taxpayer, or even a non-taxpayer? In this scenario, the default 50/50th split is far from ideal. You could be handing over a lot more tax to HMRC than you legally need to. Let's imagine a scenario. Say your property generates £10,000 in profit. With a 50/50th split, you each get £5,000. If one partner is a high-rate taxpayer, they'll pay £2,000 in tax on their share. The other partner, a basic rate taxpayer, pays £1,000. That's a total tax bill of £3,000. But what if there was a way to shift more of that income to the lower-earning partner? This is where it gets interesting. This is precisely where Form 17 comes into play. Form 17 is a declaration of trust you submit to HMRC. It allows you to change the way your rental income is split for tax purposes, moving away from the default 50/50ths rule. Instead, you can have the income taxed based on your actual underlying ownership of the property. So if one partner owns 90% of the property and the other owns 10%, you can use Form 17 to have the rental income taxed in that same 90/10ths ratio. This can be a massive tax saver if the person with the larger share of the property is also the lower rate taxpayer. However, there's a crucial catch. You can't just invent ownership percentages out of thin air. Form 17 only works if you own the property as tenants in common. Let's quickly break down the two ways you can jointly own property in the UK. The first is joint tenants. This is the most common way for married couples. With joint tenancy, you both own 100% of the property together. You don't have distinct shares. If one of you passes away, the other automatically inherits the whole property. You cannot use Form 17 if you are joint tenants. The second ownership type is tenants in common. Under this structure, you each own a specific, defined share of the property. It could be 50/50ths, but it could also be 70/30ths, 99/1, or any other combination you decide. Crucially, as tenants in common, you can leave your share of the property to someone other than your partner in your will. And most importantly for our discussion today, this is the only ownership structure that allows you to use Form 17 to split your income unequally for tax. So, the big question is, what if you currently own your property as joint tenants, but want to take advantage of Form 17? The good news is, you can change your ownership structure. This process is called severing the tenancy. It's a legal process where you convert your ownership from joint tenants to tenants in common. You'll typically need to get a solicitor or a conveyancer involved to handle the paperwork correctly. They will help you prepare a document called a deed of trust or a declaration of trust. This deed of trust is the legal document that officially records your new ownership shares. It states, for example, that partner A now owns 99% of the property and partner B owns 1%. This document is the evidence that HMRC needs to see. Once the deed of trust is signed and you've officially become tenants in common, you can then complete Form 17. On the form, you'll state your new ownership percentages, and you must submit it to HMRC along with a copy of your signed deed of trust. You have to do this within 60 days of signing the deed, so don't delay. Let's revisit our example. The property makes £10,000 profit. You've now restructured your ownership to 99/1, with the basic rate taxpayer owning the 99% share. They receive £9,900 of the profit, and their tax on that is £1,980. The higher rate taxpayer receives just £100 of profit and pays £40 in tax. Your new total tax bill is £2,020. Compared to the £3,000 under the 50/50th split, you've just saved nearly £1,000 in tax year after year. That's a huge difference, all achieved legally by understanding and using the rules. Now, let's talk about some important considerations. Firstly, changing your ownership structure is a significant legal step. It has implications beyond just taxes. Remember, as tenants in common, your shares don't automatically pass to your spouse if you die. This means updating your will is absolutely essential to ensure your share of the property goes where you want it to. Secondly, think about capital gains tax. When you eventually sell the property, capital gains tax will be calculated based on your ownership shares. The partner with the 99% share will be liable for 99% of the capital gain. This might not be a problem if you both have your full annual exemptions available, but it's something to plan for. Also consider stamp duty land tax. If there's an outstanding mortgage on the property, transferring a share of the ownership could trigger a stamp duty charge. This happens if the value of the mortgage debt being transferred exceeds the current stamp duty threshold. This is a complex area, and it's vital to get professional advice from a solicitor or tax advisor to understand if this will affect you before you make any changes. Don't let this be a nasty surprise. Finally, remember that Form 17 is a declaration. Once you've submitted it, the new income split is locked in until your ownership circumstances change again. For example, if you sell the property, or if you change the ownership shares again with a new deed of trust, you can't just switch back and forth each year to suit your tax situation. It must reflect the true underlying legal ownership of the property. So, to recap the process, Step 1. Check your property's ownership type. Are you joint tenants or tenants in common? You can find this on the title deeds from the land registry. Step 2. If you're joint tenants, you'll need to sever the tenancy and become tenants in common. This requires a legal document like a deed of trust, which specifies your new ownership shares. Get a solicitor for this. Step 3. Once the deed is signed, you and your partner must both sign Form 17 and send it to HMRC within 60 days, along with evidence of your new ownership structure. Step 4. Update your tax returns to reflect the new income split. And Step 5, and this is a big one, update your wills to reflect your new tenants in common status. This strategy isn't for everyone. If your tax situations are similar, the default 50/50th split is probably the simplest path. But for couples with a significant disparity in income, taking the time to legally restructure your ownership and submit a Form 17 declaration can lead to substantial ongoing tax savings. It's about being proactive and making the rules work for you. As always, while this video provides a good overview, it is not a substitute for professional advice tailored to your specific situation. I always recommend speaking with a professional tax advisor and a solicitor before making any changes. I hope you found this guide useful. It's one of those areas of property tax that many landlords overlook. But the potential savings are just too good to ignore. If you have any questions, feel free to drop them in the comments below, and I'll do my best to point you in the right direction. Thanks for watching. Don't forget to like and subscribe for more property finance tips, and I'll see you in the next video.